this is just the coolest to me. It means it shows you that your probability of winning with a risk to reward ratio of 4 given a mu of 0 is pretty much 0. All right. Hello, everybody, and welcome back to another episode with Sharp Education. Today, we're talking about the infamous risk to reward ratio, which I have delayed until later in this series when we've covered more advanced things, because despite how simple this concept sounds, it's not. A lot of people use risk to reward ratios very basically, assuming that they have a win rate before they have calculated their risk to reward ratio. So they're saying, I have a 30 to 40% win rate, but my risk to reward ratio is really high, so I'm making more money over time. But that's actually backwards. Your win rate is calculated as a result of your risk to reward ratio because of the variability that is just in the markets. It always exists. And I can show you that using a very simple drawing to explain a very complex concept. So let me pull up Microsoft Paint here. Now, let's pull in a picture of the stock market, just a random price chart. All right, so let's just assume this is minutely data, even though we can see that it's not. Let's assume this is minutely data, and we can see that there's some random movement. And some people will tell you otherwise, like, oh, that's not random, it's all part of an algorithm, or it's all predictable based on the previous price movements, but we all know by now that that is completely wrong. This can be assumed to be random. Now, people who mention risk to reward ratios very simply, and the way I don't like them to do it, is they just assume that when they set their stop loss or take profit, prices will suddenly go up to their take profit or down to their stop loss, like this, in a direction. And then they'll be stopped out or they'll take profit. And if they have a 30% win rate of prices just going up to their take profit, then they win more often than they lose. Simple as that. But the unfortunate reality is when you set a favorable take profit, so you have like a risk to reward ratio of 2 or 3, 4, 5, whatever it is, you're increasing the likelihood of hitting your stop beforehand because of this random variability. We can see it here. It kind of just jumps up and down a lot. It's not only going up to where you plan your trade to go or only going down. There's going to continue being this variability that will stop you out more often than it will suddenly just go to your take profit. Complex simulations of this random movement are referred to Brownian motion or Brownian noise, and that involves calculus. We are not going to be doing that today. We're going to be using statistics to dive a little bit deeper into the expected value of a bunch of different risk to reward ratios without a trading strategy. And you can add a trading strategy on top of this, but I want to show you the math behind why a simple take profit or stop loss risk to reward ratio doesn't just suddenly solve all your problems. If you think that a risk to reward ratio is going to solve your terrible win rate, this is going to correct that for you, or this episode. So let's go back over to Python or Visual Studio Code. I'm going to paste in code from a previous project that we've done together, and it is, I think, regression_all.ipynb. So our get data function is going to include the changes, the percent changes of every single column. So we have a new column for the percent change of open, high, low, and close. I also need the global variables from that same function. So let's paste those in here. Great. So now we have our global variables and our data set. Let's define the main function to just take in data at the moment, and I'll show you what our data frame looks like. Data frame equals get data. Great. So we see we have these close change, high change, low change, open change, and even volume change. And I've also included a little plot of the prices that we're looking at here. For this study, we're using minutely data. Yes, that's just what we're going to do. I think it's the most interesting for this particular study because most people are placing intraday trades. And it's also, we don't depend on a lot of data for this simulation. We always depend on a lot of data, but this is the amount of minutely data Yahoo Finance provides is sufficient for the simulation we're going to run here. So this is what it looks like over the last, I think, 2 or 3 days of Yahoo Finance minutely data of the S&P 500. Just sort of sporadic movements, random. Now what we want to do is we want to simulate what happens afterwards in this part. And we're going to be doing that by taking the average movement of all of these prices and the standard deviation of all of these prices. And then just doing a bunch of iterations of what that would look like to calculate a bunch of different scenarios with our given risk to reward ratio. So with that, let's start writing our function. Let's call data frame the main function for now so we can work with the data frame while we build this function. So let's call this simulate movements. What we want to return is a data frame. But for now, we're just going to leave it empty, return nothing. So what we want to do is simulate the movements of the prices and calculate the risk to reward ratio based on what we want our risk to reward ratio to be. Now this ratio is calculated with this very simple formula, 1 divided by 1 plus your ratio. So if you have a 1-to-1 risk to reward ratio, then you should have a 50% chance of winning, theoretically. Or if you have a 1-to-3 risk to reward ratio, then you should have a 25% chance of winning because 1 over 4 is 0.25. That is all theory. But we're going to be testing that by using a simulation of movements of prices that move similarly to how we have seen them move in the past, just based on the data we're working with. So let's set up our risk to reward ratio to be a list. So RR list, for now, we're just going to set one risk to reward ratio. It's going to be 1. And the rows of our data frame are going to be each of the risk to reward ratios that we define. So because we only have one risk to reward ratio in our list at the moment, our data frame at the end is just going to be one row. So right now, this is going to set up an empty list where we're storing data for each of the risk to reward ratio simulations. So we're going to need to include the risk to reward list in this function. So for R in, I'll capitalize R. For R in risk to reward list, we need to run a simulation. So given our risk to reward ratio, we need to, first of all, define what our take profit is going to be and what our stop loss is going to be. And those are just going to be defined as up or down. Up is going to be our R, or our risk to reward ratio, divided by 100. Because if we're doing a 1-to-1 risk to reward ratio and we're only risking 1%, then R divided by 100 is going to be equal to that. So I'm just going to write this as this. Up and down is going to equal R divided by 100, and then 1 divided by 100. Now, this is assuming that we are risking 1% with every trade. And the risk is going to be a multiplicative factor of what we are risking. So if we keep this at 1, then R, as we increase it to 1, 2, 3, 4, 5, will just be proportionate to this 1/100. But it could be anything. Okay. And again, I post this code for free on the Sharp Research Education page, so you can modify it however you like. Now, what we want to do is get a random movement. And that's where this important simulation that we remember from the Microsoft Paint application, the movements are random. You can't forecast them. You don't know what they're going to be. So for the sake of your sanity and accuracy of your simulation, you need to assume that the prices are going to move randomly. Mostly. So we're going to take the z-score of a randomly generated z-score from NumPy and multiply that randomly generated z-score by the standard deviation of the price movements we see. What is the standard deviation and mean? Let's look at that. So let's print out a couple of things. Data frame, close, change, dot mean. And I'm also going to do this for standard deviation. Okay, so the mean is 0.00001 and the standard deviation is 0.0003. So what we're going to be doing is multiplying this standard deviation by a random z-score generated by NumPy's random.standardNormal function. And if you don't know what this does, I can show you in a separate cell. This is part of why I love Jupyter. Random.standardNormal. And every time we run this, it's going to give us a different value of a normal distribution centered around 0 with a standard deviation of 1. So these are z-scores. Z-scores are how many standard deviations away from the mean are these values. And we are getting random values or random instances for this simulation. So every time we run np.standardNormal, we get a different z-score. So we're going to be multiplying this z-score by our standard deviation and call that a price movement. And we're also going to be adding the mean, the average price movement, to this multiplier. So what does this look like in our function? Z is just going to be standard normal for how many movements. In a trading day, there are 7 times 7.5 times 60, 450 minutes in a trading day. And there are, so if we did 450 minutes in a trading day, we would get an array of 450 random values from this standard normal distribution. Okay, and then if we did a set of values in this, say we wanted 2 sets of 450, now we have 450 rows and 2 columns. But if we did 3, it would look like this. So we have 450 rows and 3 columns. So we're going to set the number of steps to be 450 in our function. So steps equals, we'll leave that empty for now, and we can include that later. Steps, and then the number of simulations we want to run, or iterations, we will also include in our function. So steps is going to be 450 for 1 trading day. And iterations, this can be as many as you want. I think for like a really solid study, you want 10,000. But for us, we only need 1,000. It won't be too much slower because we're going to be vectorizing. But we can set iterations to be 10 for now. It doesn't really matter. So now we have steps and iterations included in our function, and they are going to go into our z-score acquisition, which is going to be multiplied by our movements. So let's get steps and iterations. Now, if we put 450 steps and 3 iterations, we would get 450 random z-scores 3 different times. So we could run the study 3 times to get a simulated probability of success that would be different from our theoretical probability. Remember, the theoretical probability, if you had a 1-to-1 risk to reward ratio, would be a 50% win rate. But we're going to be testing if we get a 50% win rate through simulations of a more realistic movement of prices. So we're simulating price movements, and we're getting a simulated probability of hitting your stop losses that is way more effective than theoretical, because the theory doesn't account for randomness in the price movements that exists. That might have been the most important information I give, or important synopsis of this study that I provide in this entire episode. So I hope you paid attention to that. So, and then we're going to, once we have a array of z-scores, we're going to get the movements, which is going to be the cumulative sum of the average of the share prices plus the standard deviation times the z-score we created. So we're also going to need to include our standard deviation and our average share price, which are going to be these values here. So mu is going to be this, and then standard deviation is going to be this. And we can input those straight into our function right here. And then those are going to come into account over in this part. So Z and yeah, I'm going to call this movements equals numpy.cumulative sum of the mean. So we're adding the mean to the product of our z-score times the standard deviation that we include in this function. And we need to be doing that along the 0 axis, because remember, when we do steps and iterations, we suddenly have 2 axes in this z output. We need to be doing it along the 0 axis, because that is the long ways. We're doing 450 steps. We need to be taking it along the steps, not the iterations. Now, this is complex stuff, and I hope I've done an okay job of explaining it, but I can understand if you're lost. I will be including comments in this code before I post it, so I can try and explain a little better. Show you way better. plt.plot movements. Okay, cool. So we have 3 different iterations, and this is what those random movements look like, because our average movement, remember, is 0.0001 or something, and the standard deviation is 0.0003 or something, I forget. Now this is what our random movements would look like, and we're going to be testing how many times these get stopped out or hit our take profit. So that's the next step. And if we set this to be 5, we'll see 5 different rows. And if we set this to be 10, it gets chaotic very quickly. So we won't be including this plot in the function, because I want to be running like 10,000 simulations, and plotting it is slow. But maybe in the episode I make for my short form content, I will include a picture of the amount of simulations we ran. But for now, let's keep running with the code. Let's define our take profit and our stop loss. Take profit is going to be when our movements is above up. So we remember defined up to be this 1%, because our risk to reward ratio is 1. Every time it goes above this 0.01 line here, that means we are taking profit. And every time it goes below this 0.01, negative 0.01, then we are getting stopped out. Otherwise, we're just taking the cumulative returns of this random movement over 450 days. You don't need to set a limit at 450 days, but I'm assuming that if you're day trading, you don't want to hold it for longer than 1 day. If we simulate it for 3,000, it looks a lot different, where because of the positive mu, the positive average, you almost always make money just buying and holding. So we can set the mean to be 0, and that'll look a lot different. You can see it's now just depending on the standard deviation, you get a lot of different results. But I'm actually giving us the benefit of the doubt by giving us a positive mu. But I am also going to be limiting us to 450 days or 450 minutes. So our study looks like this, or like this, or like this. This is fascinating stuff to me. I love seeing charts like this. Our take profit is when our movements are above up, and that's going to return a list of Booleans. So it would be, for this blue line, for example, it would just be false, 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 until we finally hit this take profit, where it would be true, 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 true. And then our down, or our stop loss, is going to be when movements are below negative down, because we set down to be 1/100. So for this red line, it would be false, 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 and then true, maybe there, but not for long. So we're only going to get trues like until we hit our stop loss or take profit. Great. Now, what are we going to do with all of this information? What we want to do is we want to understand whether or not our take profit hits before the end of our study. So we're going to be using our favorite function numpy.where. And we're going to be using that to identify any instance where the take profit or stop loss exists, and then taking the argmax, which is going to be 1 if there is a true. And if there is no instance where it exists, we're just going to take the number of steps. And add 1 to it because it starts at 0. So let's do this. Take profit first equals np.where. And then we have to do take profit, any of them. If any of them are along the 0 axis equals 0, we take the take profit dot argmax, and because we're using a Boolean function, the argument max will be 1 if anything exists. Axis equals 0, and otherwise we're just gonna add the steps plus 1. Perfect. And we're going to do this for the stop loss as well. Okay, so printing the take profit and stop loss first is going to return the index of the first time we encountered our take profit or stop loss. Now, when I set it to be 3,000, our first take profit occurs after 1,948 days with this random iteration, and it never occurs with this, or the stop loss never occurs in this particular random iteration. And we can keep doing this. Sometimes it occurs in 244 days. The stop loss occurred at day 244. So when we do 450 days, we can see that we were never stopped out for either the take profit or stop loss. Interesting. So we did a whole day trade and we never hit either our stop loss or take profit. So we did a whole day trade here and we were stopped out at the end. That was good. That was a good one. Here we were never stopped out. Never stopped out. This one we did take our profit. We made 1% on the day, given the simulation with a mu of 0. But if we set our mu to be what we have already seen, we're probably going to be taking profit more often. Yep. Because of this positive shift that we've seen in the historical data we were working with. I'm going to set mu to be 0 for now. You can set it to be whatever you want in the code when you post it into your own IDE. So hit take profit is going to be what happens when our take profit first happens before our stop loss first. Great. And we can set this up for there to be a limit, but for now I'm just going to have this be as long as you are willing to take your trade for. That will be the cap of whatever your study is. And then our simulated probability, our p sim, is going to equal the hit take profit, TP, and this is creative. We're going to be taking the mean. Now, how are we just going to take the average to get a simulated probability? This is going to return a list of however many simulations we run, being a 0 or 1. So if we set our simulations to be 3 or 10, if we set it to be 100, this will return a list of 100 zeros or 1s. And if 50 of them are 1 and 50 are 0, then the average of those two will be 0.5, and that will be our simulated probability. And if we have a 1-to-1 risk-to-reward ratio, what we would want to see is a simulated probability that is similar to the theoretical probability that we've calculated using this formula again. So now we have the simulated probability, and the expected value of the simulation is going to be the simulated probability times the ratio minus 1 minus the probability. So let's do, this is the formula for that. The expected value of the simulation is going to equal the p sim times r, and Then we're going to subtract 1 minus probability of the simulation. Perfect. And then I want to make a data frame out of this. So remember, we have this rows at the top, and we're going to append information to this. So rows dot append, and we're going to make a data frame column. So the risk to reward is going to be R. The theoretical win rate, I am going to include that. So P win theory is going to equal 1 divided by, and then parentheses 1 plus the risk to reward ratio. So that's just the formula we saw at the beginning of this episode. And then the P-win simulation is also going to be included. So capital P win sim is going to equal P sim. And then one more, I also want to get the expected value. So expected value of the simulation is going to equal EV sim. Perfect. Now, if everything goes right here, I want to return a pandas data frame of rows. And we should just have one row because our risk to reward list is just one thing long. There's only one feature. So if this all goes right, what I should see is a data frame with one row. And we do see it. And I've also plotted all of the movements as well. Okay. This is interesting. Now, we have a theoretical win rate of 0.5 because that's our risk to reward ratio. And with the formula, we should be winning 50% of the time. But the simulated win rate is 0.13. It's a lot lower. And I know I've calculated our win rate to only be a win when we actually hit our take profit. So all of the instances where we didn't hit our stop loss, but we didn't hit our take profit either, is counting as a loss. So that makes our win simulation or our simulated win rate way lower. But if we bump this up to 3,000, our simulated win rate will go up and up and up. And if I did 10,000, I bet this will be really close to 0.5. Yeah, it's actually above 0.5. And you can see this is all of the movements. And that's with 100 iterations. And if we did 1,000 iterations with 10,000 minutes, which is a really long trade that you wouldn't take, I'm pretty sure this is going to be almost exactly 50. It's going to take a lot longer. Oh, it's still 0.48. Now, if we have a standard deviation of what we are looking at in real life, and we set the mean to be 0, the expected value of our trades is negative. Meaning if you placed $100 trades each time, and you had a 48% win rate, you would expect to lose $4 every trade. We're gonna keep building on this. I want to see all of the different win rates, and I'm also going to get rid of this plot because actually no, I'm going to keep the plot because I like it. So let's plot. Okay. And this is the fun part. Instead of doing 10,000 days, we're going to go back to 450. And I know that's cutting us off, and it's going to make our theoretical win rates a lot lower. So I'm going to increase the mu to be what it actually was, which was, what is it here? Our average price movement is 0.00001. So that slight change is going to increase our win rate. And then, what are we doing? Instead of just doing one risk to reward ratio, we can do 0.5, 1, 2, 3, 4, and 5. So we're looking at a lot of different win rates, 1.5 even. And what we should see is a bunch of different rows for the different win rates. And this will take a while because we're running 1,000 simulations for each win rate. So the theoretical win rate for a 0.5 risk to reward ratio is 67%. And we saw that actually with our simulation. We had a 68% win rate with a positive expected value. But the expected value immediately goes negative when you start moving up to 1, 2, or 3. Look, you have a negative 1 expected value for risk to reward ratios over 2. What happens, let's just take a look at, let's make another plot. So now, for each of the risk to reward ratios, we are plotting a new random scatter of price movements. And they look like this. So we also have a data frame we're also returning a data frame with this function that is going to show us how each of them did. So simulation is going to equal main. We're no longer returning a data frame, we're returning a simulation. So let's look at the simulation. And we can see the same general trend. Once your risk to reward ratio exceeds 1 with a mu of 0, your expected value becomes negative. And this theoretical win rate diverges further and further away from what it actually ends up being with a simulation grounded in statistics and science. Fascinating. Let's do some more plotting. So plt.plot. All right, so I've made the only plot that is returned from this function the information from our simulation. And if you don't remember, it is this data frame with all of our risk to reward ratios, their theoretical wins, the simulated win rate, and the expected values. Okay, so this plot is fascinating. You can see that the theoretical win rate is always higher than the simulated win rate because of the random variability embedded in our study. We have simulated the price movements, and we have shown that over the course of 1,000 iterations, our simulated win rate is always a lot lower than the theoretical win rate because of this variance. The expected value is negative after your win rate drops below 50, and it drops below 50 really quickly, like when your risk to reward ratio is above 0.5. Now, this is just the coolest to me. It shows you that your probability of winning with a risk to reward ratio of 4 given a mu of 0 is pretty much 0. Now we can increase our mu to be not what the S&P 500 has yielded. Instead of 0.0001 or something, we can do 0.00002. Let's see what that does. This will increase our win rate a little bit, like the expected value stays above 0 until our risk to reward ratio becomes 1. But you can see that the simulation shows that variance causes your simulated win rate to always be less than the theory until your drift becomes something large, like 0.0001. This is interesting. Yeah, if you can find an average upwards movement, then your expected value will increase until your risk to reward ratio is like 6. But that's it. That's the whole study. The hard part of trading is not setting a risk to reward ratio. It's not being disciplined, and it's not coming up with a simple strategy. This shows you that the general idea that your win rate comes before your risk to reward ratio is wrong. It is determined by your risk to reward ratio. And the only way to win, even if you have a good risk to reward ratio, is to encounter trades where the likelihood of a positive drift is higher. And again, that just goes back to the most difficult part of trading in the first place, is identifying movements before they happen in an efficient market, which we've already covered in previous episodes. Sharp Edge is designed to identify those movements before they happen. So every time I place a trade, I'm working with an advantage beforehand. The next quarter of ratings are coming out in about 3 weeks now. And if you want to hop along with a model that helps you identify upwards trends where your mu can be way higher than just the random variance, it can be 0.0001. This can cause the expected value of your trades to increase if you have a risk to reward ratio. Because if you take the average movements of the top rated stocks from Sharp Edge, the average movement over the course of the quarter is a lot more positive than the S&P 500 or any other asset, where especially with foreign exchange, you're going to see average movements at exactly zero. Mu equals zero. And that will cause your simulated probability to always be substantially lower than the theoretical win rate. And unless you have a strategy that gives you an edge, you know what I'm trying to say at this point. And I've been talking for a long time. I will be making a second part following up on the results from this study because they are fascinating. But I appreciate you sticking around for this longer episode, and I hope you learned a lot. I learned a little bit. So thanks for being here. I look forward to the future episodes on this subject, and until next time, stay sharp.